talk about tokenized assets today. We're going to switch it up. This is a tech investing show, I guess, in some ways.
Okay.
Because there is no leverage. So there's not a lot that we can look at that we can do kind of in the immediate term, but what's happening in crypto? A promise of blockchain has been this concept that you can tokenize anything, right? Put it on the blockchain. That's been a theme for some time now. But you've recently seen that resurface here. It's kind of back in the spotlight. So in the last month, you've seen JPMorgan debut their tokenization platform. They have clients like BlackRock. CNBC says tokenizing real-world assets is for crypto lovers as well as crypto skeptics, which certainly there's a lot of people that are still skeptical of the technology. Mm-hmm. Some analysts have come out, and it's a widespread, and it's just really a subset of what open funds give you access to today. But the market for this could be 30 trillion on the upside. The bull case for many is 10 trillion. On the downside, it's still in the bear case, a couple trillion. In terms of assets really moving on chain, so I want to talk about kind of where we are today. It's still really early. What's happening, and the larger kind of macro trade that might be underpinning all of this. Why does any of this matter? Who cares? Sure, things are going to be more efficient, but I think there's a trade, or at least people should be aware of what's happening, because I don't think many people pay very close attention to these developments. Certainly not when prices have been kind of flat to down, which I suppose isn't exactly true of Bitcoin. It has been doing pretty well recently. So if we jump to the next slide, what is a tokenized asset? So this simply just represents a real-world asset on a blockchain network. I think people might be familiar with the idea that you could own a percentage of a painting, and it could be represented as a share or as a token on a blockchain. You are seeing tokenized real estate, but really today the current use cases are to take financial assets and just move them on chain. Because when you do that, it adds some efficiencies. There's some improvements that are introduced, right? It's lower costs. There's certainly lower barriers to entry. If we ignore kind of regulatory components and just think about global internet access, this opens up marketplaces in a way that just aren't as accessible today. There's more transparency on the blockchain network, and you're going to have increased speed and efficiency, faster settlement times, et cetera, et cetera. And so as I mentioned, fiat currencies, bonds.
Time out. Hold on for a second. So, I see the synergy for artwork. Really, really expensive. We're not talking about your $25 piece of artwork you buy from
Picassos.
Target. You're talking about your Picassos. You can't afford them. Everybody wants a piece of them. It's one of one. A house, I can see that too. Expensive house, maybe not in a neighborhood that you can afford. You want to invest in. I get it. How does it relate to stock? You can't take that 100 shares and put it on the chain, can you?
I think you'll eventually see that. We're not there with equities just yet.
Well, that's a tough one.
Well,
that's a tough one for me to conceptualize.
Why?
Because it's almost like you're taking it out of the market, or you're taking it out of the liquidity pool. So the 100 shares can be lent out and use, right? It's almost like when you trade an option, that option creates 20 other options down the line. Somebody hedges it. When you take it from the chain, you're almost taking away liquidity. That's my thinking on it. Maybe I'm not putting I'm not putting the chain through.
I don't know, because I think it's not going to happen with everything. I think there's got to be I think in order for it to work it depends on what the asset is. Obviously,
that's what I'm saying.
Artwork and
real estate, it makes sense.
It's illiquid, but if you talk about liquid assets, I think with liquid assets, it actually works. We did it on Tasty. So we were the first online broker to offer tokenized gold, and through Paxos.
Yes.
And so we tried this almost a year ago. Maybe it was longer than a year ago. We had to take it down because of what the regulators considered it. They questioned whether or not it was secure, whatever it was. They were questioning what we were doing, but nobody was trading it, so it wasn't worth the regulatory fight. We weren't going to draw a line in the sand because nobody was really trading it. Only maybe 100 people traded it in the year that we had it. Tokenized gold. I thought more people would trade physical gold, but it just didn't work out that way. Everybody just wants to trade futures or, a leverage product. And I understand the concept of dead money and things like that, but I did think that it would trade more than it did. But we were the first firm to offer a tokenized asset on the platform. So the fact that we did that almost a year and a half ago means that it's going to happen. It's not going away.
It's significantly grown since then.
Yeah,
and
right.
I agree with you in the sense that you're going to need.
I don't know if tokenized gold's grown, but other tokens have.
What's happening here?
Yeah.
This evolution is certainly it's growing, right? It's going to require regulatory standards.
See, the downside is what Tony said, but the upside is ginormous. I mean, just think how hard it is if you wanted to go out and buy physical gold.
Yeah.
Unless Costco's offering it again.
Now you're going back to physical stuff, which I like. And I know a stock share is physical, but we've made it
so
almost like an option. You know what I mean?
Let's forget about physics. Forget about the physical side.
Sure.
Let's say you want to trade something in U.S. dollars or in some cryptocurrency, and you don't want to convert your money you want to take your digital wallet and you want to buy something in
the UK,
China
or China, whatever. Sure.
Yeah. Now you can do that if you tokenize the assets. You can do that without having to go through all the bullshit, which is like going to some international bank, transferring money into some currency that you don't even know. You have
the slippage there. Yeah, I totally
have no idea how much you're getting ripped off by the whole deal. And
I don't see it running.
You don't have an account.
One-to-one.
You don't have an account at some firm there that allows you to do it. So you don't have a way to essentially do it, clear it, transfer the capital, do anything. And this, if it's tokenized, you can do it all through your same brokerage account here in the U.S. It makes total sense.
Well, the way that I tend to think about it, the model that I'll use is this is just the evolution in how these are represented in the marketplace. Mm-hmm. I really think about this more as financial system infrastructure and how it's changing and where there might be a trade as a result of kind of that paradigm shift. But if you go from physical stock certificates to a digital representation in let's say a centralized database, you have a bunch of different counterparties that are going to share information with each other in an encrypted, protected way. That's fine. That's how it works. There's nothing wrong with that today. It just could be improved by this technology. Mm-hmm. So it's not that the players are any different or anything else really changes. It's just that the way this is represented electronically or digitally is in a tokenized form. And when it takes on that form, you have some added benefits. It's not going to be without hurdles and without some friction, and I think you'd need an entire system to be on board here. But this is, an evolution from where we are today. If you think that AI is going to play a larger role, if you think that markets will be more globalized in the future, I think this will again play a pretty significant role in it. So,
I don't think there's any question. I think you're right. I don't think there's any question.
Well, let's look at what we're kind of seeing today, because it's still really, really small. So if we go to the next slide here, like I said, tiny. 118 billion if we look across chains in terms of tokenized assets. When you look at what are those assets that make up that 118 billion, they're stable coins. So that's the first use case here where you have a fiat pegged currency that's on-chain in token form. 69 billion of that is on Ethereum. So the majority of this is stable coins. The majority of this is Ethereum. Couple other chains that are playing a role here, Tron and Solana. But again, super early. You are seeing it grow. 3% is now commodities, as you mentioned, Tom, with Paxos Gold and government securities. You're starting to see the market for government securities grow quite a bit, especially given the fact that we have much higher interest rates than we did just a couple of years ago.
And now that you have higher interest rates, you're going to see this whole sector grow more, because there's another component. Mm-hmm. There's another component, which is, so all of a sudden rates are back in play, which is a huge component, which brings that's why you're starting to see these, central banks talk about digital currencies and everything else, because all of a sudden everything's back in play.
There's all voice to the yard.
That's right.
They're coming to the yard. I like that. If we jump to the next.
They're not running to tokenized assets yet, but they're
not yet. But in my view, it's pretty clear to see this is the direction that we're going in.
It's pretty clear to see that this will be a direction. Like, in other words, I don't think this is the direction we're going as much as I did 3 years ago think that this was the direction we're going.
Really?
But I do think that this is going to be one of a very viable branch of what we do. So, like, a couple of years ago, I really did think that this was going to be the future of international and kind of global expansion, but there's too many regulatory hurdles. There's too many challenges with the technology and with the acceptance, the know-how piece of it. So I think it's going to be one of the vehicles. I don't know if it's the direction that we're going. Do you know what I'm saying? I think it's going to be complementary to everything else that's out there. I think it'll be a piece of what we're doing.
Yeah, I see what you're saying. I guess, and this is maybe on my next slide, I kind of think of this as the movement from mutual funds to ETFs. Mutual funds still exist.
There's no question about that.
And
no question.
This is ETFs to tokens. The other stuff will still exist. I believe that the market for tokens, or the size of that asset class, tokenized assets, will eventually be larger, or it will be the larger kind of percentage of how capital is allocated. It's in token form, but that's going to take time. It's not going to happen overnight, certainly.
Yeah, that'll take a lot of time.
But if you think about the next 10 years, what does that look like? Extremely difficult to predict. Hard to predict the next couple of years, but I do think that's why I say this is the direction that things are going in. So we're seeing, some use cases beyond stable coins, gold, as you mentioned, treasury bills, treasury bonds on chain. You're seeing some credit markets or corporate debt on chain. You're seeing real estate, artwork. Players in the traditional sense, such as Franklin Templeton, also getting into this, which is kind of interesting to see some of these firms embrace the technology. But if we look at some of the benefits, I suppose, or what do you gain if it's represented in token form on a blockchain? And that could be a private blockchain, it could be a public blockchain. And you're seeing JPMorgan do quite a bit with its private blockchain at the moment. But ETFs, everyone's familiar with those. We probably trade them on a daily basis or trade options on them. When you look at tokens, what are some differences here? They're programmable, they're rules-based. And a lot of what's happening is automated on the ETF side, but you can rebalance really quickly. You can build products then that give you exposure to things in ways that you just can't get that exposure today, right? A simple example of that might be a token that goes out and it sells a call option programmatically on a 1 week or 1 month basis. So you have tokens that will deploy strategies on chain eventually. This is if we get to that point where this stuff is real.
Oh my God! So the AI is now going to tell the token, is going to create the token, and then basically we're going to have
the AI token.
Yeah, we don't even have to be involved.
I think there's a high likelihood of that. Yeah, I mean, if you believe that the AI is real and this is an unstoppable force, it's really hard to argue that blockchain technology isn't necessary or won't play a role in that. These things kind of go hand in hand, I think.
The question becomes when these markets, because in my opinion, the only players right now are they're all ARBs. Like, to me, every player is an ARB. Like, all the volume is just ARB.
Okay,
like,
I see what you're saying.
It's all ARB volume. That's all it is, and which is how all efficient markets start. In the option world, all the business exploded when the ARB first came on, when multiple exchanges popped up, and then so there was all of a sudden there was ARB, so the volume exploded, and then all of a sudden it went mainstream. So the token business, and from ETFs, blockchain, token, whatever it is, it's all ARBs right now, volume wise. When that eventually is how you get to the next level, which means that kind of interest then will attract, eventually the ARB goes away, which is what happens in all the listed markets here. The ARB went away, but then the market stays. That's what you're hoping for.
Right. You need that spread to bring in that liquidity, and then ultimately that spread.
Right now, the ARB is just like the adventurous people are in there trying to figure out what to do directionally, and the arbitrators just try to take advantage of the wide markets.
Yeah.
What happens ultimately is the markets tighten up, if the product's successful, if this idea works, markets tighten up, everybody comes into the marketplace, it becomes a very different world very quickly, and then the strategy starts to take over.
This is what I think everyone should really keep their eyes on if you're looking for kind of real world use cases or kind of what's really happening in DeFi. This is certainly it. And I think the one thing that stands out to me that is maybe the most interesting about this is the interoperability component. Because in a system where the financial assets are in token form, they, in a sense, are fungible as collateral. I could take tokenized Apple stock and I could provide liquidity to a decentralized exchange with an automated market maker, which we've talked about on here before. I could use that as collateral for a loan. And so when you talk about the democratization of finance, it's really just about, I think, liquidity in a sense. And it creates more opportunities and more access for people that, it's tough to borrow from a bank unless you have physical collateral, right? I can take a home equity loan, but it's tough. Sure, you could borrow against your equity, et cetera, et cetera. But this I think it increases the liquidity that exists in the system, and so when we look at what that opportunity is, and whoops, I got the wrong headlines on my last couple slides, amateur hour over here. But when we look at the opportunity, right now globally, there's about 70 trillion in assets that are managed by funds in some capacity. So when you think about just what percentage of that could be tokenized, is it 50%? Is it 35 trillion? Is it just 10 trillion? The market is pretty large for this opportunity, even though it's early. And any asset can be represented on chain, which I think is really cool because it's going to bring access and liquidity to alternative assets. You could, in some ways, think about like tokenized farmland or hard assets, which in my view is absolutely going to be necessary for people to protect against the inevitable and kind of ongoing debasement of fiat currencies, not just by us in the US, but globally. There's just too much debt. So people are going to have to protect against the fact that we have to print money. And so this gives you more opportunities to speculate or to hedge that debasement, I suppose, if this is where we go. And then you think about today, what's the trade? Why does any of this matter? Because a good chunk of public blockchain networks today are being utilized for this. So either it all moves out of public networks and into private blockchains, or we continue to see this evolve. As I mentioned earlier, most of this is happening on Ethereum. It doesn't mean it'll stay there, but I think the macro trade here is to own the underlying networks. That's Ethereum. That's layer twos like Polygon, anything that's going to be an Ethereum virtual machine. But that's the trade, is to invest in the infrastructure and just watch this continue to grow. The fees to transact on those networks are paid in that underlying cryptocurrency, in ETH, for example. So if there's increase in demand because of increased use cases, presumably the value goes up. And download the app if you want. That's it.
I like the plug.
Thanks, guys.
Very good. Last one? That was it?
That's it. Yeah, unless I got I just lost it when I had the wrong titles on the slides. It's just,
no worries.
what's going on over here?
You're all good. You're all good. We're going to take a quick 90-second break and come back. We got more Tasty Live after this with a market measure.
It's good stuff, Brian.